Heya Cryptozens, it's 10 p.m. Pacific time. The date is October 12th, 2022. Welcome back to the Crypto Overnighter. My name is Nikodemus, and I'll be your host as we take a nightly look at the crypto, NFT, and metaverse space and the industry that surrounds it. And keep in mind, nothing in this show should ever be considered financial advice. Michael Hsu is the acting comptroller for the currency for the United States. He has something of a message for his fellow regulators about the crypto industry. Be careful. Quote, learn and smartly adapt. That's the way, he says, to ensure safety and fairness in the crypto industry. Don't lower your standards just because you're worried about, quote, being perceived as an anti-innovation Luddite. This comes from a speech that he made at Harvard Law School on October 11th. If you want, you can get a copy of the text at the comptroller's website. And he's got some interesting things to say. It seems like that his point of view, it's FOMO. It's the fear of missing out that pervades the space that has had a lot to do with how regulators treat the crypto industry. He said, quote, promises of innovation and inclusion often mask crypto's promotion of a gold rush vibe that exploits people's fear of missing out on the next Google or Amazon. So it's his view that rather than taming new industries, regulators have gone too far the other way, and they have over-accommodated what they should have been regulating. It's his view that the answer to all this is a tighter, deeper cooperation between the different regulatory agencies, which I think is the wrong approach. But when all you have is a hammer, everything looks like a nail. Here's why I say that. In his search for how to solve what he sees as over-accommodation in the industry, he's drawing from his experience collaborating within the system, his years working with the Federal Reserve System, the Federal Deposit Insurance Corporation, and various state banking supervisors. That's why his solution is to layer on yet more bureaucracy. He's looking at the problem from the inside. The last thing that we need is a more complicated spiderweb of information and cooperation than we already have. We need to streamline this process. Okay, first we need to get a process, and then we need to streamline it. Now, there were questions around supervisory expectations in the near term. Specifically, areas of concern included liquidity risk management of deposits from crypto asset companies, stablecoins included. Another area of concern is finder activities, especially where crypto trade is concerned. Hsu affirmed that he remains a crypto skeptic. That said, he's keeping an open mind, he says. Quote, programmatically, composability, and tokenization hold promise. Blockchain development can be credited with bringing these ideas to the fore. And while Hsu might think that regulators are being too generous in their treatment of the industry, I can think of some other people who would probably disagree strongly. Grayscale, for one. Sticking with the subject of regulation here, shots fired in the Grayscale SEC lawsuit. The digital asset manager filed their opening brief in the case against the SEC. At issue, of course, is Chair Gensler's decision that Grayscale wasn't allowed to convert their Grayscale Bitcoin Trust into a spot Bitcoin exchange-traded fund. And so they told us that this would happen, that they would sue if their application was denied. And so it came to pass that they filed their brief in the U.S. Court of Appeals in the D.C. Circuit. And in that filing, they accused the SEC of being, quote, arbitrary, capricious, and discriminatory. It's their opinion that the SEC just doesn't like crypto, that it treats spot Bitcoin-related products with, quote, special harshness, and they are in excess of their statutory authority. Now, part of it is the indexes. See, Bitcoin ETFs that have been approved for use, they have the same indexes as the proposed Bitcoin spot ETFs. So it's their position that spot Bitcoin ETFs and futures ETFs take the same risks because it's the same market. Quote, although Bitcoin may be a relatively new asset, the legal issue here is straightforward. The Commission has violated the APA's most basic requirements by failing to justify its vastly different treatment of Bitcoin futures ETPs and spot Bitcoin ETPs. So all of this leads them to believe that they and Bitcoin, they've been discriminated against. And they're claiming the SEC's actions are damaging the 850,000 shareholders. Quote, given the Commission did not approve the trust to trade as an ETP on the exchange, the value of its shares cannot closely track the value of the trust's underlying Bitcoin assets, depriving trust shareholders of billions of dollars in value. Now, this filing comes after the SEC shut down Grayscale's application to convert GBTC to a spot Bitcoin ETF on June 29th. So it looks like the next steps are SEC submits their brief by November 9th. Grayscale then submits a reply on the 30th. And then finally, both sides submit their final brief by December 21st. Now, staying with the ETFs here, Valkyrie Funds is going to wind down one of their Bitcoin-related ETFs. It was announced yesterday that they were shutting down the Valkyrie Balance Sheet Opportunities ETF. Now, this is a crypto investment that offers indirect exposure to Bitcoin. So this fund is set to be taken off the NASDAQ exchange. Valkyrie plans to liquidate the fund on October 31st, 2022. And so what they're saying is that shareholders can sell shares up to the end of the trading day on the 28th. Whoever is left holding shares of liquidation gets a cash disbursement value equal to the net asset value of their shares. Now, Valkyrie said that their decision to liquidate the fund came as a part of their ongoing review of products. They said, quote, this action was taken after thorough consultation with the firm's board of directors and comes after it was determined that the discontinuing the fund was the best course of action for all involved. Now, Valkyrie is one of the major players in terms of crypto-related ETFs. They launched one of the first Bitcoin futures ETFs in the U.S. last October. And even though they're winding this offering down, Valkyrie will still have the Valkyrie Bitcoin Miners ETF. This was just last February. 80% of its assets track the securities of companies that derive their value from Bitcoin mining. And still on the topic of ETFs here, let's take a look at Dubai, because 21Shares is a provider of crypto exchange-traded products. Well, they've stood up a physical Bitcoin exchange-traded product. This product is traded on NASDAQ Dubai under the ticker ABTC. Now, if the idea of a physically settled Bitcoin product sounds funny, it's easy enough to explain. It doesn't mean you have to come up with some physical representation of a Bitcoin. What it means is that this fund is 100% collateralized in Bitcoin assets, and they track with one-to-one leverage. In this case, the fund's underlying crypto has been deposited in an offline wallet for extra security. NASDAQ Dubai joins 11 other exchanges that 21Shares ETPs are listed on. Two of the biggest markets are Germany and Switzerland. Their CEO is Hani Rashwan, and he said the Middle East Northern Africa region has become a hotbed for crypto companies and exchanges. Part of that, I'm sure, is due to the 30% tax India recently enacted on crypto holdings. And then you still can't write off your losses. Anyway, this news comes after the parent firm of 21Shares appointed Sharif El-Haddad as the head of MENA in August. He used to be part of a firm in Dubai where he previously attempted to get a physically backed crypto fund going, but was ultimately unsuccessful. As we like to do on this show, let's take a look at the numbers. At the time of writing, the global crypto market cap is $921 billion. That's up 0.3%. The top 5 cryptos by market cap are Bitcoin up 0.35%, Ethereum up 0.91%, Tether, USDC, and Binance Coin down 0.36%. TempleDAO is a yield farming DeFi protocol. Hackers hit them yesterday for over $2.34 million. Word of the exploit comes to us on Twitter by way of a user named Spreak. He is the one who spread the news of the hack, along with a screenshot of how the funds had been moved. BlockSec and PeckShield, both blockchain securities companies, they both confirmed that the exploit had indeed occurred. BlockSec points to the migrate stake function. On Twitter, they said, quote, TempleDAO has been attacked. The root cause is the insufficient access control to the migrate stake function. PeckShield said that the thief used SimpleSwap for funding and that they transferred $2.34 million in ETH to a new address. Stacks is a decentralized app powered by TempleDAO. They said one agent was responsible for the hack. Confirming what BlockSec reported, they said it was missing an only migrator check. Now, they're not recommending that people deposit any more money into Stacks contracts until the problem is fixed. Quote, the DApp has been taken down to avoid accidental usage. This is now under control, and the exploiter can do no further harm. Remediations will be made for all affected users. The hacker's address comes up linked to a Binance account, so TempleDAO is going to work with Binance to investigate. Quote, we're following up with Binance and will initialize a white hat bounty for the exploiter. We are increasing our existing bounty with Hats Finance and establishing secure communications if the hacker chooses to return funds and receive a legal bounty. Details to come. Now, according to DeFi Llama, TempleDAO's total value locked was about $57 million. So this hack represents only about 4% of their treasury holdings. A much more impressive total was stolen from the Solana DeFi platform Mango Markets, because they were hit for over $100 million in crypto. So what happened is the attacker manipulated price oracle data. This let them take out under-collateralized loans. It was OtterSec that first spotted the trouble. They tweeted out that the exchange had been drained of $100 million because the hacker manipulated the price of the exchange's token. Then they took out loans from Mango's treasury. They said, quote, it appears the attacker was able to manipulate their Mango collateral. They temporarily spiked up their collateral value and then took out massive loans from the Mango treasury. Now, shortly after, we heard from Mango's team as they tweeted their warning for users not to deposit funds until the situation was more clear. They also asked the attacker to begin talks about a bug bounty. And we're going to talk about that because greed knows no bounds. Anyway, Team Mango confirmed that the hack was due to the manipulation of the price data feed for the native Mango token. They said that they disabled deposits and were continuing their investigation. Quote, we will be disabling deposits on the front end as a precaution and keep you updated as the situation evolves. So at the time of writing, Mango tokens are selling for 2.9 cents each. A couple of days ago, that was 4.1 cents each. That's a roughly 29% drop. The hacker got away with a variety of cryptocurrencies. $50 million in USDC, $26.7 million of a Solana staking token, $24 million in Solana, and they also got $14.7 million in Mango tokens. Now, Mango says that they're taking steps to have third parties freeze those funds. Now, as far as the bounty goes, the hacker made off with over $117 million in crypto. So this is where things start to go even greedier, because the hacker responsible made demands for a settlement. These demands were posted on the Mango Markets DAO governance forum, and that DAO is very important to this part of the story. So Hacker Guy proposes the hacker returning the Mango tokens, the Sol, and the Sol staking tokens. Mango DAO chooses the address. In return, the hacker is demanding $70 million for the bounty on the hack. Now remember, this is a proposal put forth on the DAO's governance forum. So this guy does the obvious thing, right? He votes yes for his own proposal using the million of token that he stole. No worries though. There are not enough votes for a quorum. So his proposal is that the Treasury pay the bounty, pay off bad debt from the Treasury, forgive any future claims against accounts with bad debt, and, Don't freeze the money and don't prosecute. Reactions were predictably negative. One user wrote, quote, "You're disgusting. What you did is wrong in every way possible. The responsible thing to do would have been to disclose the vulnerability to the team, not exploit it. I hope the law enforcement community shows you zero mercy." Now let's change gears here and go from stealing money to those who are supposed to protect it. Because Caitlin Long is not happy. She's the CEO of Custodia Bank, and she accused the Federal Reserve Bank of hypocrisy. She was unhappy with the central bankers because of BNY Mellon. Now, BNY Mellon is the oldest and largest Wall Street bank. They announced that they were launching a crypto custody service yesterday. Bitterness for Long. Because she's spent 2.5 years waiting for a decision from the Federal Reserve on her bank's application for a master account. This account would let the bank function like its traditional competitors, establishing equal footing with companies who lend out their customers' fiat deposits. In fact, they have sued the Federal Reserve back in June, calling the Fed's delay patently unlawful. Tyler Lindholm is the state policy director for Senator Cynthia Lummis. He is also the former chair of the Wyoming Blockchain Task Force. Described this as evidence of favoritism coming from the Fed. Quote, "This is the Federal Reserve picking winners and losers. They picked the oldest bank in the United States to custody, but have blocked fintech startup banks in Wyoming. So what Long wants is for Custodia Bank to be given master account. And this master account lets them send payments directly to the Fed. With one of those, Custodia could bring crypto into the U.S. banking system in a really big way." Last month, the Fed released a new framework for fintech firms and, quote, "other lawful financial firms," specifically on how they got a master account. And we talked about this on the show. There's 3 tiers and everything else. But this wasn't even a possibility before. So now here's the issue. BNY Mellon, they already have a master account. They're up ahead. They're in the lead. So they just went to the New York Department of Financial Services and got approval to begin offering crypto custody services. They didn't have to jump through any federal hoops to get that approval, whereas Custodia has been waiting an excessively long time for that same consideration. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. We'll see you tomorrow night.